Well, thank you all for joining us this morning. I'll call to order the City Employee Pension Fund Board meeting for July the 29th, 2025. Like I said to most everybody earlier, I'll be chairing the meeting today in place of the mayor. So the first item of business is a motion to approve our May 6th meeting minutes. I'll entertain a motion.
So moved.
Okay, are there any discussion or changes that need to occur? All those in favor, please say aye.
Aye.
Aye. Any opposed? That motion passes. Thank you. Okay, next up.
Baxter, just one thing, Councilmember Savigny, in order to be counted for quorum, you have to have your camera on.
Thank you, Glenda.
Yeah, I'm actually struggling to get my camera on.
So we technically don't have it. Yeah.
I'm going to log in with another computer. Okay, so hold on.
Thank you.
Sorry.
Thank you, Glenda.
I figured someone would tell me that. I am looking beautiful though this morning, so I
We
definitely want
can't
to
see your face.
Oh yes, yeah.
Okay, so I suppose we probably need to wait until he gets his camera on and maybe redo the vote.
Sorry about that.
That's okay.
I'm almost there.
I know, summer is hard.
Yes, it can be very difficult to use. I love Microsoft Teams. So, computer audio, phone audio. Okay, gotta turn on my camera. It's showing me. Okay, here I come. Let me log up here.
Wonder if it's because it's saying unverified on there. I don't know that much about Teams myself, but
Okay.
there he is.
There he is. Okay, good deal.
I know, Emma. I'm a 62-year-old technology challenged
IT professional.
former technology person. So.
All right, so let's go again. I will entertain a motion to approve the May 6th meeting minutes.
We're good.
So moved.
Second. All right, all in favor?
Aye.
Aye.
Any opposed? All right, that motion passes. All right, next up is our fourth quarter expenses. I'll entertain any questions or comments regarding that. Anybody, anything? Okay. Now, next up is our ratification letter. And I will entertain a motion to approve that item.
So moved.
So moved.
Second.
All right, any questions or comments? Okay, all in favor, please say aye.
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 Any opposed? All right, that motion passes. Thank you. Okay, the next item on the agenda is the conversation around increasing benefits for retirees and beneficiaries. This is a standing item that we typically consider in the July agenda. And essentially it is for us just to decide if we want to approve an increase in benefit, and we have to decide the amount of increase. Typically in the past, Samantha, what is the history on our recent increases, the amount? It's usually a percentage, correct?
Yeah, I think it wasn't a hard rule, but I think generally we've matched whatever the current employee raise was. Um, and let me look. I do think it was like 3%
I
last
believe
year.
so.
And I think it's since 2019, the board has opted to do an increase every year.
Yeah. Okay. I'll welcome any conversation around this item.
I mean, personally, I think as representing the retirees that as long as it doesn't put them in a situation where they are receiving too much that could impact them negatively with their other, I think that's the only thing that I'm ever concerned with. But I think giving them as much as they can have, since the funding mechanism is very
As it is.
healthy, very healthy.
Yes.
So I would support not knowing what the salaries are, since I haven't looked at this very long time. As long as it doesn't impact them in a negative manner, I would support fully giving them the most that we could give them.
Okay. As
I
our
would need
employees did get
leadership
a
instead of-
3% increase this year. Glenda, do you see any reason why 3% would be a detriment to the recipient?
No, I agree with what Councilmember Lamb.
Oopsie.
I'm going to say that.
Just say Susan, please.
Susan,
Just Susan.
as long as it doesn't impact them with any of their other benefits, I agree with us doing what we have done for our employees.
Okay. And just for our new members' benefits, during COVID, we did try to give a little bit more, and it ended up hurting our recipients in the long, like a little bit. There was some issue there, so
Oh,
that's why we're
God.
having that conversation.
Was that with the supplement?
It was,
Yeah.
it was right, Samantha. I think that was,
Yeah, the one-time supplement ended up increasing and made some of them lose their benefits, but with the steady overall percentage increase, it's been fine.
I saw Susan unmute. Did you need to add anything to that?
No, I agree completely. It was the one-time adjustment that put them over their Social Security limit that reduced Social Security. So the monthly increase will not be a detriment for them.
Okay, thank you.
And the number's 3% for, is that what it was?
Yeah, that's what we've done in the past, or matched our employee raise, right?
I'm willing to make a motion for a 3% increase. So moved.
Okay.
Second.
Okay,
Second.
thank you. Any further discussion? Okay, all in favor, please say aye.
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 Any opposed? All right, that motion passes. And when will that take effect? When will,
If we're going to base it off of the ordinance that we typically do, it takes effect January 1st of the upcoming year.
okay.
And council will
that's
approve it
yeah,
at the end of
and
it.
that's subject to council approval. Okay, good deal. So that'll be on probably our first docket back, I suppose.
Yeah.
Okay, good deal. All right, our next item on the agenda is our update from PFM. So I've got David Calvert and Allison Corbley and Floyd Simpson on. And I guess you guys can take it away and give us a review on last quarter.
Sure, most definitely. Just brief introductions because we have a few new faces. My name's David Calvert. I'm a relationship manager for PFM Asset Management, and I help oversee this relationship with Allison Corbley. Allison, would you like to do a brief introduction?
Sure. Thanks, Dave. I'm Allison Corbley. I'm a relationship manager for our multi-asset strategies, or also called OCIO. And that is the risk-seeking portfolio we manage for Lexington. I'm located in Atlanta, and Dave and I work on a couple relationships together, such as this one. Floyd?
Hi, I'm Floyd Simpson. I am the Director of Public Markets Research as of beginning of March. My interaction with Lexington in the past has been on the strategist side. I'm also a representative of our investment committee as I am a sitting member.
All right. Thank you.
I am hopefully going to be able to bring up the presentation, and so you can all see it. You also have a copy that I sent over last night. But just going right into the presentation on page 4, you could see a overall snapshot. We divided up the city employee pension fund into basically 2 components: the return seeking portfolio, which totals $33.7 million, and then the liability defeasing portfolio, which is basically a carve out of all the expected benefit payments that are anticipated for the remaining retirees. Overall, as of June 30th of 2025, the total market value was $38.6 million. And on the bottom left, you can see how that portfolio is divided up. The return-seeking portfolio has essentially a target allocation of 60% to equities and 40% to fixed income securities. As of June 30, we have about 59.1% to domestic equities combined with international equities, with 38.5% to domestic equities and then 20.6% to international equities. This chart only gets updated once per year when we receive the actuary report. We should have an update in the September to November timeframe. So at the next meeting, we might be able to have this updated. But this shows the historical actuary funding ratio. Basically, the value of the pension fund divided by the expected benefits that are anticipated to be paid. Since we've began managing the portfolio, this has done very well given market performance. And as of June 30th, 2024, basically there's 6.5 times more money than the benefits that are anticipated to be paid from this pension plan. Overall, here you can see a snapshot of the change in market value of the return-seeking portfolio. So during the second quarter, the return-seeking portfolio increased in value by $2.28 million, or a return of 7.27%. That was slightly ahead of the benchmark, just by only about 2 basis points, or 7.25%. This is in light of a very volatile quarter. If you recall, at the beginning of the second calendar quarter in April, that is when Trump announced the series of tariffs that are slowly beginning to take effect. It had an immediate market reaction of dropping the S&P 500, and was down about 19% from its all-time highs. Since then, the S&P 500 and the NASDAQ has set new all-time highs in the months of June and July, but definitely the theme for the last 3 or 4 months has been volatility. The liability defeasing portfolio, you will see disbursements coming out in order to pay benefits. The change in market value was just about $67,000, and the total return was 1.31%. In light of this volatility, in April, we adopted a slight underweight to equities and an overweight to fixed income, while also removing the dedicated high yield strategy, which Floyd will talk about later on in this presentation. And then over a 12-month period, the return-seeking portfolio increased by $3.5 million. So you can see that the bulk of the increase in market value just occurred in the last 3 months. With a 12-month total return of 11.7%, while the benchmark return was 12.21%. The combined portfolio increased in market value by about 10.9% for the 12-month period. And here are historical returns of the account, and Floyd will also cover this later on in the presentation. So overall, there are 3 main market themes that we're seeing. The U.S. economy is continuing to show signs of resiliency, but there are pockets of signs of cooling. The headline employment rate continues to show strong strength with the unemployment rate at 4.2%. It is slightly higher than it was about 2 years ago in the high 3% range, but we are still seeing it basically remaining in that low to mid 4% range. Inflation has been range bound. The Federal Reserve would love to see the inflation rate come down to about 2%. We haven't seen that yet. In fact, the last couple reports showed inflation ticking slightly higher. The Federal Reserve remains on hold because they anticipate that the tariffs that are going to start being assessed over the last couple months and into the latter part of the year will be inflationary in nature. So this has caused the Federal Reserve to at least be on hold for now. There is a FOMC meeting decision that will be released tomorrow. But overall, the markets are anticipating them to remain on hold at tomorrow's meeting. The latest dot plot indicates that the Federal Reserve is sort of in two camps, where they think that maybe rates can be cut by about 50 basis points for the latter half of 2025, so 225 basis point cuts. But there are quite a few members that think that maybe they shouldn't cut at all. So we're going to continue to see how that plays out in the economy. But we are definitely in the trend of lower fixed income yields in the future. And then finally, there has been a lot of volatility, not only in the equity markets, but also with the fixed income markets because of the budget bill. There was also a debt ceiling debate that was resolved with the decision with the One Beautiful Bill Act. And then the yield curve continues to steepen beyond 2 and 10 years as there are concerns that the recent tax legislation will increase and add to the overall deficits in coming years. So one thing that has remained in the news and has actually just appeared again this past weekend, you may have heard that there was an agreement with the European Union in order to have an effective tax rate that is slightly better than what was originally expected. But there has been essentially a steady stream of information related to tariffs and countries coming to the table and negotiating rates that might be a little bit lower than they were originally set on April 2nd. Overall, in order to put this in a global perspective, before the recent announcements, the effective tariff rate of U.S. imports was in the 3 to 4% range. And with the latest series of information, we're probably going to see tariffs that are selling in around 13 or to 15% per se. So these are going to be much higher rates than they've been historically. And we have to go back to the late 1920s in order to see tariff rates as high as they are going to be set in 2025 and 2026. The other big piece of information that came out in June was the reconciliation bill. This basically codifies some of the priorities of the President Trump administration. Most notably, the tax reform is expected to increase the deficit by $4.6 trillion. There is a whole series of modifications to the tax code. One of the things that you talked about earlier was the impact on Social Security recipients. There is a carve out where retirees are going to actually be able to exempt more of their income so they don't have to necessarily pay taxes on Social Security benefits. Much of these cuts is coming from the expense of decreases in Medicare and Medicaid. And one of the focuses of PFM Asset Management is with state level governments. And we are hearing that there are some concerns on if this is going to have an impact on beneficiary payments and whether or not the state might have to pick up additional Medicaid costs because the federal government is not going to reimburse them in the future. Overall, the Congressional Budget Office is estimating that the total deficit impact is about $3.3 trillion. That number is not for a single year. That's over a 10-year time frame. So you're talking about a $330 to $350 billion increase in the deficit based upon the projected impacts of this particular bill. Overall, the economic picture looks pretty good. This shows the various index levels of the CPI, the Consumer Price Index, year over year. If you recall, in 2022, 2023, there were remaining remnants of COVID that caused inflation to spike higher. It took quite a while in order for those prices to more or less stabilize. We're still seeing prices increase year over year. We're not seeing them decrease, but the rate of increase is much slower at about 2.4% compared to 6.4% at the beginning of 2023. The unemployment rate has ticked higher. It was 3.5% at the beginning of 2023. Now it's at 4.2%. This is still essentially good numbers from a historical perspective. And then maybe one of the real big surprises during the first quarter was GDP growth, or gross domestic product growth, actually declined by 0.5% during the first quarter. Economists are expecting to have a sharp rebound, to have GDP growth in the 2 to 2.5% range in the second quarter. But I think there was a lot of folks that were a little surprised about a negative GDP print. And that was because partially, a lot of companies were importing additional goods before the tariffs were taking effect. And then, as we alluded to earlier, there is quite a bit of controversy with the Federal Reserve on where monetary policy ought to be. If you see lower rates, that's generally more stimulative to the economy, but it will also allow for inflation to kind of tick higher. So board members, this is what their reflections are as of June 30th, and they are showing anywhere between 0 to 2 cuts in 2025, with additional cuts in 2026, 2027. So the bias is for lower rates in the longer term. Allison, I'll turn it over to you.
Okay, thanks, Dave. If we take a look at the quarterly returns for the equity market, certainly a divergence on the equity side from what we saw in the first quarter, and I'll elaborate on that in the forthcoming slide. But we did achieve double-digit returns in the U.S. equity market, and primarily it was risk on in the marketplace. The high-tech companies, large cap high-tech companies that were dismayed in the first quarter came roiling back in the second quarter. This has a lot to do with the uncertainty around tariffs, as well as the Liberation Day, in which they put tariffs on hold and the decisions around tariffs on hold. And the markets did react positively, specifically the U.S. equity marketplace, as well as the international marketplace. Now, if you look down, the non-U.S. equity, if you recall from the first quarter, again, very nice returns. First quarter rationale behind that is the U.S. dollar. The weak U.S. dollar really helps the non-U.S. equity marketplace in achieving returns. But you had the same situation as in the second quarter for the non-U.S. equity. And on top of that, you have valuations very attractive on the non-U.S. equity side, which really did help propel the equity returns. And again, if you look at the fixed income, I know that Dave has alluded to fixed income. We're anticipating that rates will be lower in the long run. And if you look historically for fixed income, these are the returns we would likely see on a quarter-to-quarter basis, returns in the single digits for fixed income. And if you look at the high yield number, that's close to the bottom of the page. We did see in the first quarter where high yield was in itself, because of its typically determined as a more riskier exposure in the fixed income marketplace, did underperform. But with the markets coming back with solid ground, high yield was back in favor again, as risk on was in the marketplace. Now, I know that Dave had indicated just some earlier slides and talked about the volatility of the marketplace. Let me just expand on that. 40% of the portfolio, of the risk-seeking portfolio and the multi-asset strategy portfolio that Floyd is a member of in managing, consists of U.S. equities. And this is what we're looking at, or have been looking at, for experiencing for the first half of 2025. So the three lines, I'll share if you can't read on the key here on the screen. The black line is the S&P 500. The gray line is the S&P equal weight index, where all constituents in the S&P 500 are equal weighted because it's a cap weighted indice. And then the Bloomberg Magnificent Seven. So these are the Magnificent Seven issues. Again, the Magnificent Seven are constituents of the S&P 500. So the purpose of this is to show you that in the first quarter, the Magnificent Seven collectively underperformed the S&P 500. We did reach a high in the U.S. equity marketplace in February, but we closed the quarter in negative range. However, the Magnificent Seven roared back in the second quarter. Certainly a comeback that outperformed the S&P 500, and the S&P 500 in itself hit an all-time high at the close of June. So really volatile markets. A lot of that really rests with the incertitude around tariffs. Now, if we look at the right side, looking at the blended growth rates, you can see in the quarter 2025, the navy blue represents the S&P 500. While it's below the Magnificent Seven, almost 3 times below the Magnificent Seven, moving to the quarter 3 of 2025, growth estimates show that there is a narrowing there, that you are seeing the Magnificent Seven come down, and you see the S&P 500, the broader index, increasing. If we move to the next slide, and one more comment on the U.S. equity marketplace is that analysts' expectations for future growth are positive. There is a positive trend. If that have already reported returns, about 50% of companies in the S&P 500 have reported returns. 80% of those companies reported positive returns, positive results. And the expectation is we will see that going forward to 2006. Moving to the next slide, there are several factors that our investment committee takes into consideration in managing the portfolio. Dave did highlight the top 2 rows specific to the economy, which our team continues to take a close eye on as we're making investment decisions. I'll talk about the bottom 3 and what is corporate fundamentals. Dave alluded to really resiliency. Corporate fundamentals continue to be solid generally. We are seeing some missteps, but continuing to see trajectory growth. There does remain the concern about tariffs and how they will play out and impact companies. But while tariff pressures continue to weigh on earnings and growth outlooks, in the U.S., deregulation efforts are generally seen as constructive for growth for companies and expansion for companies. On the right-hand side, valuations, I believe we had this in the orange last quarter, or if not, maybe in the yellow. We did see that correction in the first quarter, where we did see U.S. equities pull back and get to some leveling in historic range of their PEs and valuations, but that completely changed in the second quarter, where we saw a very strong equity market. Valuations, particularly in the U.S., are a bit rich, but in the non-U.S., they continue to be in favor, lower valuations, more attractive valuations. So there is a balance. And on the right-hand side, we've been in the red territory for quite some time. And we should not be complacent of what is transpiring. There still are concerns as it relates to Russia and the Ukraine. Again, this has been going on now for over 2 years. And then we have also the concern with the Middle East. And then on top of that, we have just the deglobalization as it relates to global trade and tariffs. So that does remain in red. And this is how the investment committee is looking at these particular factors as they make decisions into the portfolio currently and into the next 6 to 12 months. But typically, we do have changes from quarter to quarter. As we move to the next slide, positioning of the portfolio, one item that Dave noted on the first part of the page is the defensive position we took in the portfolio. Again, recall how the markets have been very volatile, a lot of uncertainty, a lot of noise in the marketplace. Investment committee made the decision to de-risk the portfolio slightly by taking an underweight to U.S. equities, particularly in that large cap range, but just in general for U.S. equities, as well as a slight underweight to non-U.S. equities. And to transition or to redeploy that rebalance to core fixed income. A very much a conservative approach in light of, again, the uncertainty as it relates around tariffs. We have also in the second quarter or the first quarter and into the last quarter and into the first quarter removed any exposure to high yield fixed income. What we have done in the second quarter is, in light of somewhat Liberation Day, somewhat as decisions have been made regarding trade policy and negotiations have been taking place, decisions made, we have transitioned the portfolio back to your strategic weights. So everything pretty much in the yellow straight down, still somewhat a defensive position in the portfolio, not looking to take an overweight in maybe some of those asset classes where there are high valuations, like in the US, but letting the portfolio drift, participate in the market, but stay within your strategic weight and your asset allocation. With that, any questions before I turn it over to Floyd to talk or to speak to the performance of the portfolio, the risk-seeking portfolio?
Thank you, Allison. Does anyone have any questions so far?
I have a quick one.
There we go. That's what was taking so long. Shut up, Mary. Mom has a meeting to go to.
All right. Hey, my question was, you said that you made those changes within the range of our, I just wanted to make sure you made them within the range. And then, like, was there a slide that had the current or those percentages?
What are you saying?
We don't have a slide that shows the current day percentages. It's as of the close of the second quarter, but they will be in line with your strategic weight. So if you move to slide, Dave, can you move the slide to the asset allocations, probably close to the end of the presentation? There you go. Yep. 2 up. There you go.
Right there.
Mm-hmm. You want to take over, Floyd?
So for your question about the ranges, your ranges are defined. You have the target allocation right here on the second to left. Then from there, you see your target allocation, 40% within 40% within domestic equity, 40% within fixed income, and then 20% within international. You'll notice that as of 6:30, slightly underweight to domestic equity, a little bit overweighted to international equity. That's really more due to appreciation of that. And then, of course, as Allison mentioned, slightly overweight to fixed income. For your ranges question, because that's where you're getting towards, you'll notice that the minimum we can do is 20%. The maximum, according to your IPS, for domestic equity is 60%. Zero, we can go down to 0 for international equity. We can go up to 40 for international equity. And then within fixed income, we can go as low as 20% or a maximum of 60%. Now, if you look at the history of your portfolio, we've never gone to those extremes. Within your portfolio, usually at maximum, there's, even going up to 50% within domestic equities is considered a lot. The most you should ever see this will be maybe closer to even 44%. Again, that's a 10% deviation, which is still a fair amount, which means there has to be a high level of certainty behind that.
And then a follow-up question from that then. When you do the, on the slide that you were basically comparing to the market, my guess is you were changing, every time you change, or every quarter that you change, the target number changes based on the weighting. Does that make sense?
Yes. So to what you're talking about, that would be to that investment strategy overview slide. On that slide, the black dots are the current outlook to what you're asking about. And then the white dots are for the the outlook 1 quarter ago. So you can definitely see the change.
No, it's not
I will
that.
notice, right.
It's
And
not that.
yeah, there it is.
I'm asking about a different one. I'm sorry. If you
Okay.
move up the slides, it's the slide that basically is the overall performance over since 2015, and you have those. The lower number is the target, and then the number on top is the performance. And I'm just saying you're changing. No, keep going. Keep going. Keep going. No, it's not that one. Not that one. It's the one that has basically 2 lines on it. I'll find it.
Okay, I know where you're. Okay, this one.
Yes, that one there.
Okay.
So my guess is the benchmark would change over time because you're changing percentages.
No.
Nope. Stay steady.
The only time it changes is if we change that, we change the strategic benchmark. That's the only time it would change. And that would be through your IPS. So if it's a 60-40 portfolio, then it reflects that benchmark 60-40 and would not change unless there was a decision made by the committee to change the respective benchmark to, let's say, you're going to change it to 70% equities, 30% fixed income. And that's where you would see we would be a blended benchmark. We would change it according to when the IPS was changed. So the benchmark does not, Dave, fluctuate with the strategic weights or decisions the committee is making in the portfolio. Does that answer your question?
Yeah, it does. But I mean, it seems like the range is so big that it like, if, for instance, you really underweighted for a long time, your benchmark then would change to that underweighted piece. Does that make? I mean, it seems odd that it doesn't do that, but
it does. I understand what you're saying, and the objective would be to show that underweight of taking it to that asset class was an optimal decision the investment committee made to outperform the benchmark. Yep.
I got it. Okay. I'm good. Thank you.
Thank you for the question.
Anybody else have any questions? Okay, you guys can proceed.
All right, so Dave, this takes us to page 27 of portfolio. So for page 27, this gives you your investment returns since the inception period, including up until end of 6/30/2025. What you'll notice for this is that since inception is 7.33 versus 7.20. So what that denotes is that, over the period, long-term period, we've outperformed. For that, if you think about this, actually put this in reference to the 60-40. 60-40 type of portfolio, you're expecting a return within a 6.5% type of range. And so, your goal is to, number one, outperform your pension benefit obligation. You want to make sure, like, look, I'm outperforming that hurdle rate. And then from there, okay, if I'm doing that, how's my benchmark doing? How's my portfolio doing? Those are the things that you really want to focus on and or have in mind. So you'll notice, if that's 60-40 gets you to about, let's say you're, about a 6.5%, that's better than what that's around the rate that you're looking at. The actual assumed rate of return that you need to have. 7.2 is higher than that. 7.33 is higher than that. Also, since inception, that also denotes, probably outperforming about 5 out of 9 calendar years. 10 years, you see the same. 7 years, a little bit lower. 5 years, a little bit higher. The 3, the 2, and the 1 are really trailing, especially the 3 years trailing, just because of the time frame that happened within, I want to say, calendar years 2022 and 2023, which were low periods for us performance-wise. And then, I know that the second half of 2024, we lagged some within our portfolios, especially domestic equity, as you start to see the Mag 7 start to come back. Looking at this performance over, the current year to date, so that's January 2025 until June 2025, 7.49 to 7.52, so essentially about right on top of the benchmark. For the quarter, 7.27 versus 7.25, so again, right on top of the benchmark. When I go through these, I really try to judge it because of the type of funds based off of, how many active managers did, outperform versus underperform. That will essentially give you a bar of, okay, well, am I going to be able to outperform or underperform? So for the quarter, you'll notice that for domestic equity, we had 1 out of 3 managers outperformed. Our active managers, those active managers are Aristotle Atlantic, Putnam, Jacobs Levy. We have about 75% of this portfolio within an ETF, so they're passive management within there. Unfortunately, 2 out of those 3 managers underperformed. As Allison mentioned, it was really a growth market, so you did have technology surge back. So if you were underweight technology or you did not have certain holdings, especially in that space, whether it's technology, financials, consumer discretionary, or industrials, it really was a lag for you. Aristotle did well because Aristotle had a good exposure to, it had a good exposure to technology, it had a good exposure to the communication sector, which did well, and consumer discretionary. Putnam, on the other side, took a slight value tilt, which is what they do. But, while, it did not help out for this quarter, it helped out first quarter, but not second quarter, which is why they lagged. Jacobs Levy as a whole, that one did lag. It definitely had more of a value tilt within their portfolio. But that has been a headwind for them. Looking at their performance over a longer term basis, whether it is the 1, 3, or 5-year number, 5-year number they've outperformed. But if you're looking at it from a 3-year number and a 1-year number, there has been some issues. As being head of public research as of since March, one of my main things has been diving down into the portfolios to figure out what's going on to make certain changes. So that's something that we are in the midst of making a change for. When that change will be noted, it should be noted hopefully by 7/31. So if you're thinking about that within the next couple of days, you'll notice that change will pop up within our upcoming holdings. International. Before I go into the next section, any questions about the total portfolio as a whole, performance from inception until now, and then anything else about domestic equity?
Does anyone have any questions? Okay, Floyd, thank you. You can go on.
No problem. International equity. This has actually probably been the one that's really been more of a bellwether for us. But we have had struggles, and I think that's where you kind of see a little bit of inconsistencies. Part of my role is to help solve those inconsistencies within there. What you'll notice for international equity for both the year-to-date time period and the quarter-to-date time period, you'll notice outperformance 20.10 versus 17.9 for the first 2 quarters of the year, 13.37 versus 12.03 for the current quarter. Again, this goes back to hit rate. So how many managers did we get right? 4 out of our 5 active managers, WCM 91, Acadian, Aristotle, Schroders, 4 out of those 5 outperformed. Essentially, you're going to have outperformance within this portfolio. The one key thing within here is that we have about 50% passive, 50% active. And so within our active managers, we had a good hit rate, hence the outperformance. For the the 2 quarters, so from January 2025 until June 2025, we outperformed. We also had a really good hit rate, 3 out of 5 within that time period. The one thing that we have been keeping our eye on, Aristotle is lagging significantly as of 6/30. A big portion of that was the fact that they had names such as LVMH, which had done well last year, that they continue to hold, but it's really had some pullbacks. You had a lot more going to technology. They haven't been big in technology. they have names such as LVMH, they have names such as Heineken. Thinking about it, that they really have a real like value-centric Warren Buffett type of buy and hold philosophy within that portfolio. So even when their names fall out of favor, they still hold them because their view is that they're still good companies, so they're going to come around. It's just, hey, they're out of favor, but from their perspective, they should have other names within their portfolio that should be in favor coming forward. Again, if you look at the portfolio over a longer term, performance actually has been pretty decent. It's just, this current 6 months, it hasn't been the best time period for them. Last but not least, I'll highlight, 2 rows from the bottom. Schroeder's Global Emerging Markets. This is the manager. Year to date, slightly trailing. For the quarter, did a little bit better. Mixed results, if you're looking at it as a whole, since they've been in the portfolio. This is a manager that I do have the team looking a little bit more into because of they are our only emerging market manager. We do have a different expectation level for them. The one interesting thing is that, emerging markets as a whole has been more efficient. And so I do know that that's been harder for active managers as a whole. So, one of our things within the team has really been focusing on, will this manager be able to add value going forward? And, you'll notice as of 7/31, that's something that we are finishing up, and we'll have a decision on if we think they'll have value going forward. For that, any questions about international equity before going into fixed income?
Anyone? Okay.
And then last but not least, fixed income. This usually is an area that, we've done, historically very well within the portfolio. If I think about it for the current two quarters, first quarter really did struggle just because of that pullback, that exposure that we did have to high yield, which you actually do not see here as of 6/30. That was a drag for performance. And so high yield was a drag for performance first quarter. Second quarter, it did, it started to come back, but that did lag for that first quarter, which is why you see that underperformance for January 2025 to June 2025. For the quarter, we're essentially flat at 1.20 versus 1.21. Going back to that hit rate, if you're looking at it for the quarter, about, this is the area that we have majority active management within here. We don't have a ton of passive. So, if you're looking at active managers, PGIM, TIA, Penn Mutual, PineBridge, Brown Brothers, you'll notice that we had a really good hit rate. About 4 out of our 5 managers outperformed. That means that we should do very well, which is something you can expect for the quarter. One thing about this fund is that it's actually, a little bit more sensitive to the credit side because a majority of our active managers do have a higher credit exposure. So if credit does well, then they will do well. Usually you have seen that in the past. That's actually one of the main reasons it's been able to outperform in the past. Again, this quarter was in line, but if I looked at the managers up and down, there was still some really good manager performance, for the managers as a whole. With that, anything else? Any questions that anybody has? And I'm sorry, it actually was 5 out of 5, not 4 out of 5. Any questions that anybody has about the fixed income portfolio or any of the changes that I've mentioned that are on the horizon?
Anyone? Okay. Thank you all
David,
so much.
no problem. David, Allison, while I'm on the phone, is there anything else that you feel like I need to cover with the investment committee?
I think we're
No.
good.
Thank
Okay.
you, Floyd.
Thank you.
Appreciate it.
Okay. Does anyone have any general questions about their presentation? Okay. Thank you all so much for your work. We appreciate it. Appreciate you being with us today. Okay. Does anyone else have anything for the good of the whole? All right. With that, I will entertain a motion to adjourn.
So moved.
Thank you. Second?
Second.
All right. All in favor?
Aye.
Aye.
Any opposed? All right. Thanks so much, guys. I appreciate it. Have a good day.
Bye.
All right,
Thank you,
well,
you too.
Bye.